Careful now, there's a trap out there for both the bulls and the bears. I'll show you exactly why overconfident buyers can be punished, and why sellers are already at strike two. One more and they're out. Tomorrow should be a big session with the labor data in the pre-market, which the market generally has been hyper-reactive to. It should be a decent catalyst to help us navigate which of these two traps is ultimately going to unfold. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY daily timescale for a quick overview simplified of the 2 traps, and then we'll get more detailed as the video goes on. The first trap is for overconfident buyers to ignore the fact that there's still a technical threat of a lower high on the daily timescale as long as price is underneath the bottom end of this multi-day range from back here at 634.65. That is a mistake. The next mistake and trap is for sellers to assume that the market is going to crash and this lower high is bound to happen. We're going here and we're breaking the neckline, right? You could start to imagine how this maybe acts as the left shoulder, this is maybe the head, this could possibly be the right shoulder. The mistake in the trap here is to assume that the lower high is already in force and oh my goodness, the market's going to crash. Why is that a mistake? Because you can clearly see that price action is not accepting inside of this previous range back here, and so far this week, that level has actually acted as support at 627. So it doesn't mean throw your hands up in the air and do absolutely nothing about the daily chart, but it would be a mistake to not acknowledge both perspectives here when we're in between a trend change. So speaking of the trend, what's going on here with the trend and where is our trend count? The low of last Friday technically makes an equal low to the last higher low in the daily trend count, and we pulled back from the highest high in the trend count. So is this equal low enough to change the trend in the downward direction? The answer to me is absolutely not. We would need 2 things. We would need, number 1, a lower high, and then we would need another equal low down here, and then the breakdown. This is the exact head and shoulders formation that we were just talking about as a possibility, but not a guarantee. The first step for this to even come back into view as an opportunity would be a breakdown on the daily at minimum underneath 627 here. These previous balance range highs cannot hold as support. Sellers would prefer that this lower high sticks via some sort of intraday breakdown that looks like this to get back down to the equal low. Now, I will acknowledge here on the bear side of the market, if this lower high is produced, the odds of the equal low breaking down after a lower high are dramatically increased. So if this ends up being the situation, then I would be very open-minded to the breakdown of 618.50 to yield lower prices, likely at minimum, to the previous all-time high test. Now, this is the bear case. If that does not play out, and this happens, we either get bullish consolidation remaining over 627, or heck, if we get a follow-through day tomorrow up and over the bottom end of this 4-day balance range from back over here, that's over once again, 634.65. If we're above that level, then I would really just start thinking about how can we navigate back up to the equal high. Because remember, one of the things we want to do here is fall back on the higher time frame trends. Whenever you're in the market and you're sort of thinking to yourself, what's going on here with the trend? Should we have more confidence in the upside, the downside? What's going on? Well, if we revert up to the weekly chart to get a greater sense of what the trend is, obviously it's up off of these lows. And we've been talking about this in the Saturday videos for quite some time now. We did acknowledge that there was, a change in tone via the bearish engulfing bar last week, but the next question becomes, have we taken out the low of the bearish engulfer? Is there any sort of weekly follow-through in the downward direction? And the answer is absolutely not at this point in time. Let's go back down to the daily here, because the next thing I want to point out is, technically speaking, on the Monday session, we did open inside of Friday's range and underneath the top end of the balance range. So in the intro, when I said bears have 2 strikes, strike number 1 is the failure from the sellers to keep prices underneath the previous balance range high. If we had stronger sellers participating in this market, Monday really should have yielded a lower high, left that gap unfilled, and we should have been trading back down here towards the equal low, putting pressure on that neckline. Obviously, that's not the case with what we're dealing with currently. Now, it's not all free and clear because the buyers do have an issue as well. We'll get to that in just a second, but the daily chart basically tells me, at least, I want to remain bullish if we're over 627. I want to get even more bullish if we're over 634.65. And if we set an equal low, obviously inherently we would be underneath 627, I'd be very open-minded to the breakdown here to complete the full trend reversal. We would have highs, lower highs, lows, equal low back here, right? And this would bring in automatically via the breakdown of 618.50 a lower low. That's the daily time scale. Let's get even more granular here on the hourly chart. What you can start to see on the hourly time scale is even more compelling, right? If you think about the moving average, the 20 SMA, that's the orange moving average line on the screen here, notice how on the Tuesday session, the market gapped up. It failed to hold a gap fill reversal over the previous day's high. It also failed to hold over the breakout level here, and it failed to hold over the consolidation lows, which we remember as value area low from the Monday session. So on Tuesday, the failure here, the failure here, and the failure at the lows left the sellers with an upper hand to come into the Wednesday session. The open down here underneath 629.70 roughly gave the opportunity for bearish consolidation, and ideally sellers would have liked to see something along these lines to start to navigate underneath 627. Clearly, that was not the case, and the market rallied higher. So as we're balancing these data points, it seems to me that stronger sellers cannot pick up the momentum that we had here into the end of last week. There were multiple opportunities. Number one, opening inside of Friday's range. Number two, completely failing the gap up on the Tuesday session. You can see today's Wednesday session closes back over that 631.50, and therefore, if we're counting hourly trend, we have lows, we have higher lows, we have highs. This is a higher high. Even if you want to count today's session, that is a higher high. So on the hourly chart, you are back in an uptrend, and you will remain in an uptrend so long as any pullbacks now support over the 20 SMA. Notice once again, this consolidation, the reason I brought it up moments ago, it was this level here. The market broke back below. Sellers had a little bit of that edge headed into the close on Tuesday. Wednesday blows that edge out of the water, and we still have a shot at an hourly higher low to preserve the hourly uptrend, right? So that's the upside, and it seems more apparent that the bulls have the edge on the hourly chart. This would be an opportunity I would look for, something that does this. I would either try to get long off the daily 20 or back over 631.50, or if the market just rallies out of the gates, let's just say that the labor report comes in and the market's over the moon about it, I would love to trade not long into this level, but I would like to look for the break over 634.65, pull back longs that support above. You can clearly see this balance range from off to the left. I would like longs here that then rotate back up towards the all-time high. Something to carry forward in the narrative is that we certainly have the overnight all-time high, which is unrepaired, right? This is the improper end of the auction at 641.60. This does not guarantee that we go there tomorrow, the next day, or the day after that, but generally, this is not how all-time highs are set. It's a data point that we're carrying forward, and it will act as a target over time. So that's the bull edge here that we can start to see developing based on the hourly trend. Now, if we want to play devil's advocate, of course, if this is going to turn into a double top, let's say it's a higher high double top on the hourly, this is what the bears want to see for that daily lower high, correct? Now, where do we get bearish? It's underneath the neckline, which totally aligns with the argument we've built thus far on the daily at 627. If the market breaks this, then guess what? On the hourly chart, you have a low. That would be a lower low if the market ends up yielding this opportunity right here. A lower low underneath 627 should start to target firstly 624.25, this pivot from here, and then really the bottom end of the range at 618.50. So the bears can have risk reward that looks like this, and then ballooning runners like this, but it's going to require quite a bit of work to actually change the hourly trend back to down. The only other short you could take, and it would be a counter trend short, is if the market opens here under 634.65, looks above the level, fails with a lower high here, I would target something like this possibility, and then I would remember that there's a shot for a higher low here. If you take this short on the lower high intraday, this is like a 5 or maybe even a 15-minute lower high here. If you take that short, you just need to remember that the hourly trend remains up, right? This is a scalp from point A to point B. You're not overstaying your welcome. You're in, out, hello, goodbye. Then you're really reevaluating at that point B at 629, 70. All right, and heck, you could even get it here. You could technically support over the FOMC low at 631.50 here, right? Something that does that back in the upward direction for the same concept, hourly higher low. So that is what we have, out of this hourly chart. Another thing I want to bring up here is our Fibonacci's. If we come in from the high down to the low, notice that we have perfect confluence with the 38.2. The reason we're talking about this is because if this was going to yield bear flag consolidation, sellers want to keep prices in the bear flag under the fib 38.2. That would have been underneath 627. You can see once again that Monday opened below. It did not happen. Okay. If we come back and we look at the 61.8, what do we know about 61.8? The more time we spend above a fib 61.8 with candle closes, the higher the likelihood of some sort of full 100% retracement. So we will carry that forward in the narrative as well as a little bit more of a bullish data point here. The last thing we could say is if we bring out our Fibonacci, not fibs, but rather the intraday anchored VWAPs, this is perfect. What do we have confluence with right here? This is the low of the major breakout of the balance. We do this. This is the balance range. This is the break. This is the higher low above. That VWAP is right here, 631.50, building the argument for bullish consolidation, or heck, if this does go higher first, pulls back in, I would look for support here. This is the highest high, all-time high anchored VWAP. That'll slowly offer confluence at the 629.70, reinforcing that. And we won't really change our tone to bearish until we drop this anchored VWAP, which comes from the Friday session. It's the gray dotted line right here, which is currently at 627. So all of the anchored VWAPs and the Fibonacci pull from the all-time high to the low down here, point B, is suggesting that your key watch just has to be the resolution of 627. If anything bearish is going to happen, you really need to be back below that level. So that's what we have here. The next thing I'll point out is a little bit of the data point to neutralize the bulls, right? Because it's not rainbows and butterflies here. I got to be honest. If you're not familiar with what this dashboard is, check out the video tutorial in the top right-hand corner on the market internals. But here we go. Just like if you were in the group, we were talking about this yesterday, we talked about it in the pre-market prep, just like the internals on the breakdown from Tuesday, right? Because Tuesday was the day where the market sold off. Just like the internals were very neutral there, and we were saying, well, I don't really feel like this is all that bearish. Well, on today's rally, right back in the upward direction, was it really all that bullish? We really don't have strong volume inflows. If anything, they closed the day red. That's not great. If I hide this study real quick, I can show you the ratios through the intraday. We really stayed pretty stagnant around 1-to-1. That's a parity read, even flipping down here into negative 1.1, basically. It's not strong when it comes to volume flows. So as we think about the market moving in the upward direction here, was it led by big new money buyers at the exchange level? Not really, which is why I said in the introduction, overconfident buyers can be punished if we don't see follow through, which again, look at the advanced decline line. Technically closes negative here. The only caveat, look here, this is the cumulative tick. Closes technically red. It's a very flat build. It does not indicate at all a trending session like what we had. The only caveat that I could possibly skew the data points slightly to lean more bullish than bearish is simply pointing out that on Tuesday, the index score was abysmal. This is an index score that is very indicative of chop and nothing more and nothing less. You can see here today that the index score is actually a little bit better, getting close to double digits. Not fully double digits, but pretty darn close. And for those who are unfamiliar, the sort of, not green light, like, oh my God, let's just full portfolio, but the sort of confidence-inspiring read here is double digits. If you're 10 or better, could be net positive or net negative, then you want to go in the direction of that trend. You could see again on the Tuesday session, I think the average in here was something like a -6. This was a -6. Today was about a 10 on the upside. Right around in here. So a little bit more confidence in the index score, but not by a huge margin. And once again, trying to balance the data points by just saying, it doesn't look like at the exchange level, we had massive participation from new money buyers. This was not at all like what we had on Monday. Monday was a good example of what new money buyers look like, right? Big uptrend here on the cumulative build. You can see the inflows are up and over 300 million. The advanced decline line is up and over the 1500 mark. The index score was nice and steady through the session, more than double digits, something like 15 or 13. That's a trend day with confidence, okay? So this neutralizes the data just a little bit. But it gets better than this because we can go on over to our market profile. This is going to be really impactful. If you're not familiar with market profile, check out the video tutorial in the top right-hand corner. But take a look at this. One of the things that we carried forward into really the Tuesday and today's session, Wednesday, is look at the Tuesday low here on the single prints, right? A-period single prints did not close. So in the introduction, I said there's really two strikes for the sellers. We talked about number one, the open inside of Friday's range, but number two is that the sellers on the Tuesday breakdown could not rotate all the way through the single print post in the A period here from Monday. There was very thin volume at price. That leaves a little bit of a red flag. Hypothetically, if we had stronger sellers, they should have no issue rotating through that, right? There's very little volume commitment at price. There's nothing to support the bid. So the fact that the market just turned around here, I don't want to say arbitrarily, because if you do something that looks like this, it's really not all that arbitrary, but the fact that the market did not close those single prints in A period does strike me as a bullish nuance. Now, the next bullish nuance coming from market profile is if we think about the Tuesday session, you have a double distribution with a little bit of B period single prints separating an upper and a lower. The market opened today inside of the prior day's range, inside of value. If you're a stronger seller, you don't want to go back into distribution 1. You want to see a rejection here. Did that take place? The answer is no. And take a look at the value area and the point of control from today. Value area is inherently higher. Excuse me. Really suffering with this cough thing here. Thanks for bearing with me. We have the point of control higher. Look at Monday's point of control. Also higher relative to that. So all things considered, it does not seem, based on market profile, that sellers did a good job of really getting follow through from the breakdown from last Friday on Tuesday, right? Because Tuesday was the day that there was downside. So there's a little bit of a discrepancy with no follow through from the buyers on today's session from the market profile, market internals, But all up, I would tend to align a little bit more so with the concept of buyers remaining in control of this market based on the investigation we've just gone through, right? We've talked about the daily opportunity for an equal low and not really going through a trend change. We've talked about how this is an hourly higher low. The fact that this is an hourly higher high. We're over the anchored VWAPs. We're over the 631.50 Monday high from back here. It's the FOMC low. We've talked about all of this. I will change my tone to being bearish if we're back in here and consolidating like this. I'll be very open-minded to this look over here underneath 627. But until we're below that level, I would maintain a small edge on the buy side. I don't want to be an overconfident buyer, blinded and not paying attention to what we're seeing here. But generally, if we had to balance the scales, the bulls do have a little bit of that edge. With that, let's jump into the NASDAQ as we sort of reset here. Bear with me on the vocals. All right, let's jump into the QQQ. Daily time scale. It's going to look very similar, right? You could see here, top end of the balance range, we actually opened above it on the Monday session. There was no threat for the sellers to keep prices underneath. Didn't happen. That's 557, so automatically a little bit more bullish here on the tech sector. The next thing is our overhead supply. Where did we close today? We closed over the level at 566. Once again, a little bit more of a bullish data point. If we're thinking about the 20 SMA, we've recaptured. If we think about the failure of the gap up on the Tuesday session, stronger buyers should have gone gap fill reversal. They should have gone for the level hold here at the 20 SMA. Didn't happen. So it's the same acknowledgments, but slightly more bullish just based on position relative to this previous balance range back here and this overhead supply listed up here. We do also have the overnight all-time high, which is weak, needs repair. It's the improper end of the auction. That's 577 on the QQQ. If we take a look, excuse me, over at the hourly chart here, you can see the same thing. Lows, higher lows, highs, higher highs, higher highs. This is a little bit overwhelming in terms of the levels here. The base case, or I'd say the line in the sand for a pullback, the FOMC low is sort of, I'm leaving it there because I find it to be a valuable reference point. You can clearly see the market blasted right through it. If we get a higher low above it, that's great. It's a reference point that I want to be aware of. Once again, it's these Thursday lows from FOMC. Jeez. FOMC. Matt, not FOMC lows. These are Thursday lows from just the big gap up. That's all. The FOMC lows would be here on the spiders. Did I mislabel that? Now I'm second guessing. No, it's the same level over on the SPY. All right, so that's on me. Anyways, this level, which ignore the FOMC bit, if we hold up above it, it's over the Thursday low, over the top end of the gap. Now that I'm sort of putting my head back on straight. If we were to move underneath that, the line in the sand is 562. Why? Higher low can still be produced there. Daily 20 hold. It's also the neckline of this as like a 15-minute double bottom. So if you could stay over 562, buyers have a little bit of that edge to express still, and I would really look for longs back over 566 to become more confident over this previous pivot high. We are at the upper edge of the weekly expected move on both the S&P and the NASDAQ. It's not the end of the world. It's something to be mindful of. And once again, overconfident buyers, if you're just willy-nilly long up here and like, oh, I guess markets are going to all-time highs, it's just no-brainer. If you get too aggressive like that, probably a bad idea, right? You need to have a firm stop in place. It could look like this, right? Target that level, stop here, entry here, something like that. Risk reward makes sense on that front, but I would not just be a blind buyer chasing it here, extended with no stop, okay? Back to the main pathing idea on the NASDAQ. line in the sand, hourly higher lows, lows, higher lows, possible higher lows, 562. Ideally, right, if this is going to unfold, this is a possible entry here if you're looking for that next little bit of confidence. If this is going to turn into a double top, a higher high double top, let's just say we gap down tomorrow morning on the jobless claims. If we're here, I would also caution the short side being short underneath 558.85 into 557. Why? Because it's that balance range high. Right? So although, yes, right, this is going to look like, oh my God, the market's falling out of the sky. Oh my God, we're underneath the double top neckline. Just understand that if you're technically shorting in the hole, as we would say, short in the hole at the top of the previous balance, 557, I mean, that seems ripe to me for the possibility of one of these. Right? And then you set another lower high and then fine. If the hourly trend, so this would be a daily, let's say daily lower high. This would be an hourly, 1 hour, lower high. And then the equal low breakdown gets you in the range. This is your daily equal low breakdown. Then we take it from there, right? So we'll acknowledge that for sure. But as of right now, as long as we're over 562, very hard to be on the short side, just based purely on risk reward down here. You're shorting into a known area of support. That to me doesn't make a whole lot of sense. All right, we'll come in here with the Fibonacci's and then we'll speed round it through the remainder so my vocals can play catch up, I guess. Where's the 61.8? It's right at this level, this previous pivot high. So the more time we spend above that, the more likely it is we get the 100% retracement. Until we're underneath the Fib 38.2, it's not bear flag consolidation. It's right on the lows of the Tuesday session. I don't really love the Fib there on the downside. I would really play more so off the horizontal levels, 558.85. You don't want to be short into that, right? It's just there's not enough downside without running into this trouble first. Okay, if we come in here with the anchored VWAPs, you could see that the cluster, the top end is here. That's coming from this higher low, break and higher low, right? The all-time high is going to slowly offer confluence the more time we spend above. Generally, once again, makes more sense to lean long here for something that does this, or pullbacks to get here, and then something that, long here, more so than just trying to short this thing into the ground, because you have VWAP, you have this, right? Balance range high. I think I've been pretty clear about my concerns on the downside. If it does go for a massive, look above and fail like that, you could try the short. I would try it more so in the S&P than the NASDAQ. The NASDAQ does not seem appropriate to just be willy-nilly shorting into some of these levels down here. It's more so of a long side thesis, all right? That's the cues. Let's take a look at the NASDAQ market internals. Same concept. You could see here the action at the exchange was pretty neutral. This even a little bit more bearish on the advanced decline line. Small uptick on the cumulative build to end out the day, but it's an echoed sentiment of what we talked about in the S&P. If we take a look at the NASDAQ market profile, there is some nuance on that I think is worth exploring. First comment is the same exact thing we talked about the single prints not being filled from the A period post on Monday. We did repair the poor high on Tuesday's gap up. We do have a sort of lack-ish of material excess down there. It's not a lot of excess on the low of Tuesday, but what I think the most interesting nuance is the market profile for the NQ. Let's see if we can get this on the screen. I think I'm going to have to do it like that. Yeah, it's going to be off the screen, not all one, but look at the single prints here. Look at the single prints here. And look at the single prints here. This is going to divide the range into 4 different segments. You think of this as distribution 1, this is distribution 2, this E period would be distribution 3, and everything below that is distribution 4. A very easy trick tomorrow to determine how bullish or bearish is the market. Where do we accept? If the market pulls back at all, obviously we're slightly higher here in the post-market. If the market pulls back whatsoever, do we only make it into distribution 1 and bounce? If so, optimally bullish. If we move into distribution 2, which is this box right here, okay, not the end of the world, still bullish, looking for that. If you notice the market's really spending more time in finding acceptance in distribution 4, that would be a little bit of a red flag for the bull thesis to put that on the back burner, right? So use those single prints to your advantage here. I'll call them out very quickly for you. We have roughly, actually I wrote it down. Let me read it. It's going to be easier than finding it every single time. NQS single prints from the top down in here, 407 to 396 in here. Below that, 345 to 331 is the next zone. And then underneath this D period is going to be between 298 to 287. Okay, those are the ranges that distinguish your single prints and your quadruple distribution from today's session on the NQ. Regardless of the distribution splits or not, you can see that the value area, just like the S&P, was certainly higher. The point of control was higher. Also relative to the Monday session, everything was higher. With that said, let's get back over to the platform here. Let's finish up the broad market with with everybody's least favorite. I know, sit in your seats, calm down. Small caps, and then we'll keep this thing moving along. Small caps are important here because of what the daily chart suggests. This is a look below and fail. Look at the inside candle from today's session. Not as much competition of the time frames here because this was a balance range. It was neutral. This inherently brings in a lower low. This still could set a lower high. However, the hold over 218.60 is going to keep me bullish in the short term. If the market can break the inside candle high and do something that looks like this, we will complete a trend, probably neutralization again, coming from the lowest low back up to an equal high here at 225.50. If the market can once again break the inside candle high, something that looks like this to end the week will be a great first step to complete the look below and fail. Remember, when we do get a look below and fail, which is this here, the target is always the opposing end of balance. In this case, it's the balance range high at 225.50. The, again, structure on the lower wicks would indicate buyers have already stepped up twice off of the low, supporting there, not allowing sellers to yield a lower high underneath. Put yourself in the shoes of a seller. If you're a seller and you see this breakdown on Friday and you're like, okay, it's time to be bearish small caps, what you want to see is this action right here, lower high underneath the overhead supply. Does that take place? The answer is clearly no via the back-to-back hammers. So 218.60 is your must-watch level on IWM. If you take a look at the hourly chart, you can see how it's building out as an ascending triangle. Very simple stuff over the flat highs, looking for the Brigade bolt to navigate towards the top end of the range. What's the takeaway for S&P traders? Probably a bullish tailwind. As long as we're getting consolidation here, also a bullish tailwind, noting that sellers have failed. If we break 218.60, a little bit of a bearish headwind where we could maybe lean into some of the more bearish data points really surrounding the market internals that we've already referenced in the S&P, but it is not the end of the world. Just because small caps look like this, I would not go out and short full portfolio S&P 500, right? That's not really how that works. Okay, so that is your smalls. Let's come in here with a Fibonacci from the top to the bottom. Let's come in from the breakdown, not this gap and go type thing. Let's come from the breakdown sell side pressure to here. You can see that we don't really have confluence with anything. 50% retracement is here at 218.60s. Do we get any better if we come in from this high to this low? Not really. Maybe 61.8 breakout tomorrow sort of indicates or would allow for better odds to get back to the top end of the range. We'll watch it, but I think for now it's pretty much just a price action chart to navigate. If we jump into our anchored VWAPs, let's just see what's going on here. Yeah, break this anchored VWAP. A little arbitrary. It's not quite the same. Let's maybe anchor it to the top, that next breakout, and see what happens if we do that. Same spot, so over that high, right, that starts to get a little bit more interesting for clearing the highest high of this move, anchored VWAP. This one, of course, supportive, slowly confluence here at 218.60, reinforcing that key level. Let's look at the Russell side of the market internals and see what's happening from this perspective. You could see your same concepts where you have technically an inside day, so I guess it makes more sense that the Russell would have mixed internals as you're dealing with an inside bar on the daily. So no concerns there. Let's jump into the market profile for the RUT. You can see a normal distribution, a normal curve, a bell curve. Here's your value area. It's inside the prior day's value area. Very expected on an inside setup. So all we're looking for is a breach of the container bar high to kick off the potential for a new trend or continuation of this move in the upward direction, right? Keep it simple. No need to overcomplicate this on the Russell with the inside candle. Let's go on over to our spiders. Let's reset this and let's take a look through the weekly performance and the daily performance of the market and the sector breakout. You can see the weekly performance is led by discretionary up 262 basis points, staples 195, tech sector up 1.37%, 137 basis points. Still in the green is communications, financials, industrials, even materials, real estate and semiconductors by a slim margin there. What I want to focus on is just the fact that this is pretty much still a risk-on rotation here. And if we look at, as the market broke to the upside today, right, finally making a move over the gap low from in here, the gap up failed on Tuesday. So let's look at the performance from the open today. What was leading the market as it was moving higher and getting this thrust? You could see it was discretionary, it was staples, it was the tech sector, and it was semiconductors. So aside from the staples, these three, 1, 2, and 3 here, are very bullish and risk-on. So is the rotation, is the posture out there suggestive of buyers being active in the right spots? I think the answer is yes. At the bottom end of the barrel, it's energy, real estate, healthcare, utilities. All of those are risk-off sectors, or just lightweight in the case of energy, right? So not overly concerned with that. If we rip through some of these structural charts, let's see what's going on here. Huge move higher with the help of Amazon and Tesla today on discretionary. I love the fact that it was a very short stay back inside of this balance range, and for now, excuse me, as long as the market is over 217.65, I would have to be bullish from the perspective of discretionary. Holds here are even better, 221.75. Next up, staples. No comment. Let's move along. Let's save the voice. Tech sector, just like the QQQ, watch your lows in here. If it breaks, be open-minded to the downside. If you're over 262.85, bulls on parade. This is a thin structure retracement. You can see it here up through this high there at 265.65. Let's continue along to semiconductors. Let's go to a daily chart here. I love the hammer. Why? Because what this suggests is we broke underneath previous day's low. Sellers failed to accelerate underneath 283.20. I would be looking for longs across semiconductors, and I'll share with you my top setup in a second. Over today's high in the SMH, rock and roll. Rotate back up to the top end of the range. Because think about it. If this is going to be a head and shoulders, sellers break this down. Show me the crack of the neckline. Underneath 283.20 gets things going. Today that failed, and we closed strong back inside of the prior day's range near the highs of today's trading session. So this move over previous day's high, very interesting to me on semis. We can look at financials, not really a red flag yet. When it breaks the neckline, we'll be concerned. Not a great performance today, just an inside candle. Let's look at energy, not much to talk about here. Balance range, let's save the voice. Real estate, save the voice. Healthcare, save the voice. Utilities, fine, pulling back, lightweight sector. It's not really a big concern here. As long as we could stay, as long as there's not a crash in utilities, fine. Remember, this is the lightest weight, well, not the lightest weight, materials is. This is a lightweight sector, but it's also D for defensive. So as the market moves higher, utilities pulls back. It's not really a red flag. Speaking of the lightweight, here is materials. It is the lightest weight sector. So this lower high at the neckline, it's a little bit alarming, but I think it has more to do with the copper move and the tariff that was announced there. Because if you look at the XHB, which is home builders, look at this hold well over the top end of this, which as we know was the weekly double bottom neckline. So long as price is over $100.50, bullish the cyclical side of the economy, right? And this is looking great on XHB. You could use ITB as well if you want an alternate ETF to track. This also in an uptrend, this also over its neckline of what could be considered double bottom here. Let's take a look at communications. Another good looking chart here. Failed breakdown in the lower wick over these highs, new all-time highs. Let's rock and roll, right? Let's rock and roll. This here is, of course, something to carry forward, but for now, I would look at the daily hammer and the failure of the sellers to break and accelerate under the daily 20 as a bullish takeaway. Bonds, a little bit of a weird blip there midday, but for now, right back up towards these highs. If this breaks out, it would make sense with the narrative that Jerome Powell may be lowering rates as soon as the September meeting, and then industrials to cap it off here. Back-to-back hammers. I don't think it's worth really watching for a trade, but generally that's a bullish setup. This is a higher low. These are higher lows relative to this low. If you crack the equal highs after an inside hammer, should be getting follow through in the upward direction. That's the sector watch. Let's take a look at some ratios. Are we bullish or bearish on the risk on or off? Let's take a look. This is the glue that holds us together. It's been that way for a while. I do want to point out this recovery here, I won't give it a pure play like massive check mark. Maybe it's a neutral check mark like that, but it's a decent look. The fact that discretionary did perform so well on today's session in particular. Financials still kind of suck here. This trend is not helping. This is also not helping until it actually yields a higher low, and can look like this as an inverted head and shoulders. Not great out of communications. But the flip side of this coin is that risk off is not overwhelming. This is a little bit of a concern out of utilities, but the big pullback today certainly has it moving in the right direction. If we look at some specialized ratios, we'll start to see the same thing. You can see the glue. This is okay over the 50. This recovering over the 50. We'll go neutral on that. This still looks good. Higher low, equal highs need to break out next. So one thing to watch out for, right? Does this break out? If the market makes it to the all-time high, does this break out? Yes or no? If the answer is yes, then great, we're still bullish. If the answer is no, let's start to be a little bit cautious fishing for longs at the all-time high. Same thing here. Does the ARK break back out or not, right? This still looks good on the small caps there. Let's get into the B set. You can see that the gold ratio slowly lower. That's fine. That's good for equities. Same thing here. TLT ratio to the S&P. Bitcoin continues to hold its key area, although it did fire that bearish Sailor shift signal as of last weekly candle close. As long as we're over, 112.275, I would not maintain any sort of a bearish stance here, and it still to me looks more like a Brigade bolt. I can even just go full screen. I shouldn't punish your eyes for having to look at this very small, tiny little screen, right? If we do something that looks like that, here we go. Looks pretty darn good on Bitcoin. I would not be a big bear here for any reason. Like, this is mild consolidation. This is a higher low, lows, higher lows. The trend can continue in the upward direction. This is an all-time high. Okay, that is the BTC chart. Let's jump into the dollar. Big breakdown on the dollar here underneath this previous pivot high. In a picture-perfect uptrend reversal, buyers would have wanted to see, at least dollar bulls, would have wanted to see the hold of 98.60. That was not the case breaking down today. We'll be very curious to see whether or not we continue to the downside tomorrow on a weak labor report or a strong labor report pressuring markets higher. Now, the relationship here, of course, is that overall, we don't want the labor market to deteriorate in a big way. So a miss on the jobless claims number would not be good for the economy. However, the market's going to perceive that it increases the odds of a rate cut come September. Now, the rate cut, savior moment is not going to outweigh the damage done by a deteriorating or broken labor market. So please understand that short-term gap up through the overnight on a weak labor report probably gets faded because I think the big players who actually know and care about this stuff will just say, not really a great sign. Let's unload some of the long exposure here. Versus if the report beats the number in a good way, as in comes in underneath the expectation, you probably have a neutral pre-market because people are disappointed about the rate cut prospect, but it's bullish overall for the economy, right? So that's the dichotomy that we're sort of watching for tomorrow. And of course, rates will move in that same manner. A beat probably increases rates. A beat meaning we come in underneath the expectation. It's better than expected. Or a miss, where we come in over the expectation, probably sends rates lower because the market's worried about sending reinforcements for the labor market. Let's get into the inverted ZT, which is going to tell us our Fed tracker tool odds anyways. Still higher probabilities ever since this labor report here, which was last Friday basically, that the Fed is likely to cut rates in the September meeting. Something like 89% odds of that right now. So let's just go take a look together. There you go, 89%, right on the money. We're currently sitting at 425 to 450, so understand that this is 1, 2, and 3 rate cuts into the end of this year. The S&P only outlined 2. We'll see how and if Jerome Powell sort of dances around the opportunity, if he holds rates higher for longer. Depends on really how the continued data sequence comes out. Remember, the September meeting is a full sequence of CPI away. We're going to get more information between now and then, and I would expect these odds to change materially. But in terms of tracking how the market's perceiving it, right now, market's pretty convinced that a rate cut is required. Let's jump into the economic calendar. It's been a very quiet week. ISM Services PMI came in weaker than the expectation on all fronts. I don't think I can pull this up easily. We missed, so here's the deal. And you can go double check me on this if you'd like, but I know this is the case. New orders were technically down, prices paid were technically up, and employment was technically down. ISM breaks it out to 3 different segments on the PMI. That combination should tell you everything you need to know. Inflation is happening because prices paid is up and new orders is down, and then employment situation is down, telling you that we should probably be concerned still and watch that labor situation. So all of this aligns with kind of the rock and a hard place that Powell is kind of between, where, all right, labor is deteriorating, but inflation is still elevated. We're still getting data that suggests services inflation is still elevated. So that is a concern. Jobless claims tomorrow morning, initial and continuing, will come out. Looking for a 221. The market's been beating this fairly consistently in the downward direction. So if we do get a sustained beat here, meaning coming in underneath the expectation, as we talked about, rates should technically move slightly higher. Rates will go higher. Markets probably come down a little bit and then start to flatten out to higher once everybody realizes, okay, this is actually bullish as long as the labor situation doesn't get too out of control. A little bit of a 30-year bond auction here on the 1 o'clock time frame tomorrow. Not going to be overly market moving. Some Fed speak on Friday, but that's it. Pretty quiet end of the week. As we flip the calendar here to next week, that's where we get that next round of CPI inflation numbers. That, of course, will be interesting. If we look at the earnings calendar here, Palantir smashed the numbers on Monday after the close. Big revenue beat, big earnings beat. AMD, a little bit of a dud there on earnings, gapping down. So Palantir new highs, AMD gapping down. It did pressure semiconductors slightly lower today, headed into the Wednesday session, but nothing that I don't think is recoverable, especially with NVIDIA offering a beautiful daily chart. We'll get into that in just a second. Fortinet, honorable mention here on the gap down. I'm going to look to see if we can pick up some shares in the long-term account on that tomorrow, depending on where around the 80 level it settles out and if there's an actual setup. So that's something I'm watching there. The trade desk is an honorable mention, as is Rocket Labs and NewScale here. That's kind of it. Tempest AI gets the honorable mention as a pure play AI company, but with that, we will move along back to the platform. Let's speed it up. Let's make sure we can get the job done here. Bond relationship, not really indicating a concern for inflation here, more of a concern for the labor market. If this was breaking out, that would be a concern about inflation. It's not. If we look at credit spreads, You can see the rollover look underneath the downward sloping daily 50s. That is bullish for risk appetite in equities below. If we look at junk bonds in isolation, the HYG has been fairly sideways here. The most compelling look to me is the fact that the LQD, which is corporate grade bonds, continues to move in the upward direction. Right, this is already at an equal high relative to this. Let me just swap out the HYG for the SPX, and you can kind of see, right, how relative to this, you're already above in corporate grade bonds. Now, it doesn't mean that we have to get there instantaneously like tomorrow, but generally, excuse me, this is a little bit of a bullish divergence. Once again, caution to the shorts on that. Total breadth, this is another subtle bearish data point. It's not all rainbows and butterflies for those bulls, right? We're trying to balance the equation here. What do we see out of the moving average charts? A little rollover today as the market made a move in the upward direction. New highs versus lows. Little rollover look here as the market made a move higher. It's really the push from Apple, Amazon, and Tesla. I guess Palantir, Broadcom, all these heavier weight companies drove the S&P higher today, whereas broadly speaking, and this is why the internals were so flat, you didn't really see that broad-based participation. If you want to make it even more obvious, just take a look at the RSP. The RSP did not make a new high. It didn't even make a new high relative to the Monday high. If you zoom in here, right, you got two new highs relative to that same reference point, right? You did not get that in the RSP. It actually closes red. So breadth is not all that great. Again, trying to balance the equation. If you made it to this point in the analysis, you're getting all the goodies. If ever, I'm going to love it in the comments section. Oh, it's so bearish out there. Relax. We covered it. We got there. Let's go to the VIX. Volatility slightly down on the VIX, but the VVIX was slightly higher today. You can see here. So market's not fully on board, and I think rightfully so, with the fact that it's all clear to the all-time high. And I think once again, we've acknowledged the lower high threat is certainly there. Let's keep it going to the volatility futures though. And what you could see here is really we're still in contangos across the board, all four, 1, 2, 3, 4 different time scales. 9 versus 30-day VIX is still in contango, and the one-day VIX is lower than relative to what we had last Friday, of course, and we're in the comfortable zone. This zone in here, under 1275, over 745, very, very comfortable for the one-day VIX. So any alarms based on volatility? The answer is no. In a summary, I would say that the name of the game is to lean into the higher time frame analysis of the S&P. The weekly trend is absolutely up. This is looking like an equal low. It's not all hope is lost. As of right now, I think that the ledger leans a little bit more on the bull side than the bear side, but we've acknowledged what the two major threats are for the buyers. It's the lack of breadth, it's the lack of market internals supporting the rally that we've seen today, and the opportunity for still a lower high. Now, I wouldn't action aggressively on that until the trend confidently changes, but that's what we have as of the close on this Wednesday session. With that, quick tour through the core list of companies, top priority for tomorrow. If I don't have NVIDIA on my account statement and this breaks out over this high, something has gone incredibly wrong. Call an ambulance, send a doctor. I don't know what's wrong with me. If we break these three equal highs after producing low, higher low, higher low, high, equal high, that's a double inside candle. Based on everything we've talked about thus far, based on the higher low over the daily 20 SMA, something's wrong. So I would love to see this move higher towards the all-time high test. If the setup is there, I'll swing at that 10 out of 10 times. Even if it stops me out, I'm taking that trade 10 out of 10 times. If we open in range, great. Brigade bolt here, open on a gap up, gap fill reversal, looking for that. All right, that's NVIDIA. Next up, Microsoft. Daily chart, not really offering much. Maybe gap fill reversal here. If it's continuing to be weak, something that looks like this, perhaps. Not in love with the daily. Let's move along. Apple bending the knee, building factories in the US. Whether or not that's actually going to come true, we shall see, but undoubtedly a strong up day. Apple gets going on news, and it is news day one. If it's going to break into this gap, there's a possible long here over 215.75, closes the gap to 220.75. If it rolls over, not interested in the range. So it's really got to show and prove here and then here if Apple is going to be in play. That's it. Nothing else is interesting. Amazon, big gap from earnings overhead to possibly trade for. Pullbacks over the daily 50. Pullbacks for consolidation over 220.50. Look good here. Hourly chart. You can see here the inverted head and shoulders over the neckline. That's why 217.50 will be the line in the sand. If we could hold here, looking for either longs on the dot or longs on the dot there. If we just get consolidation and a drift, so be it. Might not actually have an entry fire off. Google, love the inverted head and shoulders look here. Ideal hold is over 194.50. Still gap to close overhead. That's 198 flat. If you look at it on the daily time scale, 1, 2, 3 equal highs. The inverted hammer got no follow through. No follow through to the downside here. Consolidation, Brigade bolt, upside trade. 198.203 gap close. Not interested if we're just chopping around. Let's move along to Meta. Another one that's kind of like Microsoft in my view. It gapped up so high, it's got to build out new structure. I like the hammer. I like the look below and fail on the previous day's low. Technically, it could be a long over the high here, but if you look at the hourly chart, this is just a big wick, so please be respectful of that opening print reversal at 776.75. I mean, ultimately, you could try to make this target the top end of the range, but I would take this one step at a time. I think there are other better setups as of right now. Tesla, a little bit of an update today, although it was not really doing anything impressive relative to the range. 2-day range breakout, as in when I say range, not the overall range, but this here. You've got the 2-day range high breaking out. Now you're tangled up with the moving averages. I'm not as interested in Tesla. I thought today was a great opportunity. There's a nice little trade that fired off on it, but for now, that's a one and done. Let's move along to JP Morgan for financials. Maybe a gap close overhead. Chart's not really compelling. Small little inside bar. This is a back tier, back burner idea. Palantir up and away. Another beautiful setup. Let's just go admire it for a second. You're only going to see it on a 2-minute chart, actually. Look at that. We still have the box around it. Look at that. Just, I mean, phenomenal, right? Phenomenal and some on the runner. So beautiful Palantir. I think that for tomorrow just becomes a matter of does the hourly pull back to the same level, 175.35? Does it get continuation? Do we Brigade bolt into blue sky territories? Gap and go. Retail continues to crush it. Proud. You know, retailers continue to crush it here. I'm pleased to be long in the long-term account. I'm pleased to be actively trading this thing. Palantir has turned into a very great and lucrative name this day. A great and powerful name, lucrative name. Glad to have it instated in the core list of companies. Slow it down. Broadcom. Anything good on Broadcom? Not loving it. I would say maybe the pullback to 298. If you look on the hourly, you could see why. That upper wick is just kind of there, so that's why it's deceiving. If you pull back through it, I think it's still an opportunity for some kind of long, some kind of hourly high or low. You're kind of in the range still, though. Not a top priority. I think NVIDIA takes the cake for semiconductors. AMD as well will be a top tier watch consolidating here. Brigade bolts into the gap overhead. This is a low volume pocket in there, obviously, because there's a gap. So over 166.15 should close up towards about 171.75. You might be mindful of 170, these prior lows coming in. Something to watch for. I think NVIDIA would be first, AMD would be second, Broadcom would be third if I had to rank the semiconductors. Let's take a look at Robinhood, another great possible setup here. I don't like the balance, I have to admit that, but I do like the fact that this did not yield a lower high underneath. This did not yield a lower high underneath 104.50, which was certainly a possibility based on the opening breakdown today. So consolidation here over 107.25, I would look for all of this pressure to basically release up towards this 111. All right, so that is Robinhood in the upward direction. Let's get into these ideas. The first one is on CrowdStrike, CRWD. There we go. We're looking for a lower high at 455.75 for a rotation to the downside that looks something along these lines right here. And as a matter of fact, I don't know why this just jumped into my mind, but I do remember that there was supposed to be a conversation, I think, between Trump and Jensen. It looks like 180.45 in the after hours, so a little bit of a gap up. We'll see where it lands in the morning. I don't know why I just thought of that, looking back at the CrowdStrike thing. But anyways, just double checking that I'm not feeding you some BS information with a huge move lower or higher already. That would be, of course, important. So CrowdStrike, back to the point. Lower high here trades back down to the equal low. That's kind of the risk reward for shorts. The reason this is interesting because on the daily, you have a downtrend here, and you also have a head and shoulders breakdown. You're underneath the neckline. You're looking for a retest rejection of that neckline at 455.75. That's CrowdStrike. Next up, we're going to take a look at Oracle. Oracle looks good on the daily with an inside hammer and at the all-time highs, basically. If you look on the hourly, notice how this is a double bottom over the neckline. 256.85 should target 260 and then blue sky territories beyond that. Right, so very simple watch here. Looking for the double bottom to play out over the neckline. That is Oracle. Last but certainly not least is Coinbase. Jumping on into some crypto. If we take a look at Coin, look at this here. This is an interesting longer-term ad spot, which is why I have that alert. But generally, this previous area of resistance is trying to act as support. Notice the failure to go lower today. You looked underneath prior bar's low, closed inside of prior bar's range. If we zoom in, you could really start to see how this, let me just adjust this so it's not so hard to look at. This is a short-term inverted head and shoulders, and over 303.75, is likely to yield, let's set an alert there together, some kind of, pinch up towards this 313. So that's the trade idea I'm looking for on Coinbase, something like risk and reward in the upward direction. With that, I'm going to absolutely stop talking and give the voice la voz, some rest here, some much needed rest, and hopefully we can do it all over again tomorrow morning for the pre-market prep. Appreciate you guys bearing with me. I know that it's probably not easy to listen to some guy hacking up coughing. It's not even a lungs thing. It's weird. Don't know what it is. It's been with me forever, but you don't need to hear about that. You need to hear about trade ideas, and we've been through them all. You know my stance on the market. Have yourself an awesome afternoon. You guys know the deal. If you want the full analysis, the live analysis intraday, you can feel free to check out the live squawk linked down below in the description. All the other resources are listed down there as well. We're not going to change anything. We're still doing the live show at 8 o'clock Eastern time every single morning. Come on out to the pre-market prep for a game plan on the session. Then we jump into the squawk box afterwards. So I hope to see you here back again tomorrow morning. Have an awesome afternoon. Have a green trading rest of your week. And as always, I'll sign off the same way. I will see you in the next one.